Hello, good morning, and welcome to Almus Market Mornings, your daily dose of updates on the financial markets. Coming off from the weekend, let's dive right into some insights as the market prepares to walk the tightrope in the VUCA world, which is, as we know it, volatile, uncertain, complex, and ambiguous. We've had a lot of updates on the geopolitics over the weekend, and I'd request JK, please highlight a few right away. Thank you.
Hey, good morning. Thank you, Shikhar. So, as we come to the end of historic month, witnessing huge volatility across the markets, we also realize that we are far from seeing the end of it. In fact, in the last 10 days, attention has almost completely diverged from interest rates to geopolitics and with what a force. While Ukraine issue was always simmering in the background, it was a shock to most observers when Russia actually attacked its neighbor. Markets were ill prepared for it, and the reaction, as one would expect, has been vicious. But this situation is one where we are seeing big headlines every hour, and the impact on the market is huge on both sides, depending on what we are focusing on at the moment. During the weekend, there was some relief that Russia and Ukraine would get into a negotiating table, and possibly peace process would start. But as we open on Monday, the situation again taken a big turn for the worse for investors. Amid central bank and commercial bank sanctions, as well as personal sanctions, and talk of swift constraints, combined with significant credit rating downgrades for Russia, capital outflow from Russian assets are now expected to accelerate fast. US and European nations have decided to partially exercise the nuclear weapon option in terms of economic sanctions, cutting off a number of Russian banks from the main international payment gateway SWIFT. This will have the effect of fund flow from one country to another, as well as on the trade side. We need to be aware that workarounds to SWIFT have been tried in the past but have not been proved effective. Assets of Russian central banks are also expected to be frozen, constraining Moscow's ability to access its overseas reserves. Russia, on its part, has suspended gas flow to Europe and has also ordered market players to reject foreign clients' bid to sell Russian securities from today. We suspect nervous traders facing margin calls and want to be the first, the smarter, or the cheat and sell first before asking questions. Investors would have become even more jittery after the news indicated Putin has put Russian nuclear forces on high alert. This is despite some potential silver lining of talks between Ukraine and Russia. So it's clearly essentially putting in place forces that if there is a miscalculation could make things much more dangerous. US futures are down more than 2%, erasing most gains of Friday. Gold recovers back above 1900. US Treasury yields are down again. On the currency side, Euro has nearly fallen 1% from Friday's top. Oil trades 4% higher from where it closed on Friday. Russian ruble has a whopping 38% weakness today as they stare at the economic sanctions. In the short term, Euro is expected to be the worst affected, followed by UK, as both have large investments in Russia. Gold has a good correction from the peak of 1970 and below 1900, presents an opportunity to diversify for investors. On the economic front, headline PCE index was 6.1% versus 5.9% expected. However, it is a core PCE that FIT cares about. That reading was 5.2% versus 5% year on year. This is the highest reading since 1982. But does the market really look at economy and other news right now with focus completely on geopolitics and the economic sanctions? For the rupee, the situation is adding to the challenges of traditional sanctions on Russia. India's trades will be impacted due to moves to ban Russian banks from SWIFT, while Russian move to cut off gas supplies to Europe will push up oil prices even further. Big losses for the global investors in their investment in Russia will lead them to further unload more investments in other markets, including India. This means FII outflows will continue, keeping the local equities pressure and the rupee on the weaker side. Expect rupee to trade between 75 and 76 range, with the PSU banks expected to be active on both sides. New developments are happening every minute and swinging markets wildly, and one needs to be nimble as always. So global risk aversion is being played out as indicated by 10-year yields, which is now dealing at 1.9% versus too high on the uh, you know just before. Similarly, 2-year yields is also now trading 15 basis points lower at 1.4%. Short-term money market is almost fully convinced that Fed would be unable to raise rates by 50 basis points in the current situation. And most people are veering down to the conclusion that 25 basis points hike could be there in March. In India, the 10-year GSEC yield closed at 6.75% on Friday after a successful auction of all securities by RBI. 10-year GSEC auction cutoff came at 6.78% as expected. The yield will be supported at 6.5%. As I said, new developments are happening by the minute and swinging the markets wildly. We will, on our part, try to update the developments and implications as fast and as quickly as we can. Meanwhile, corporates need to be focusing on risk management rather than adding to their risks. I mean, trading activity should be limited while managing the risk will be the top priority. Thank you. Have a nice day. We have a short week this week because tomorrow we have a holiday in the markets, and we talk again on Wednesday, if not before, due to any new developments. Thank you.
All right. So as we heard, markets were a bit ill prepared, and now we got to see ourselves if we can prepare and be nimble, as JK mentioned. Outflows, volatile markets, sanctions, even more uncertainty on the trade. All of the existing factors needs to keep risk management as one of the priorities for any of the corporates existing. Margin calls, limit exhaustions, and there are numerous things which are going to come. We hope that you keep yourself prepared. Let's go ahead for a holiday and meet again on Wednesday. That's it for today. Thanks, folks.